All right, listen up. Market opens in 30. We enter on the dip, ride the momentum, and exit before the bell. Alpha monitors order flow. Bravo manages hedges. Charlie watches our exit triggers.
Welcome back to Breach and Clear Trading. In this lesson, we're taking what we learned about ATR, median of price, trend lines, and fair value gaps, and putting it all together on live charts using YM and NQ. The goal is to show you how to combine these tools for clear, structured, tactical trade setups. Let's start with the average true range, or ATR. On your screen, you'll see the NQ 1-hour chart. At the bottom, we've added a 14-period ATR indicator. Notice how the ATR expands during high volatility sessions, like the New York Open, and contracts during consolidation. When ATR reads 25, that means price is moving an average of 25 points per hour. That number becomes your baseline for stop and target placement. If you're trading a 5-minute setup with a 25-point ATR, a 10-point stop is too tight. But a 20-point stop gives the trade room to breathe within normal volatility. Next, let's add the median of price. We'll mark the recent swing high at 15,600 and the swing low at 15,400. The midpoint, the median, sits at 15,500. Watch how price consolidates near this level before making its next move. This is equilibrium, where buyers and sellers agree on value. When price trades above the median, we call that the premium zone. It's expensive. When price trades below the median, that's the discount zone. It's cheap. Institutional traders often look to buy below equilibrium and sell above it. That's the core of market efficiency. Now, let's draw our trend lines. Connecting the last 3 lower highs, you'll see a clean descending trend line forming resistance. Every time price pulls back to that line, sellers step in. Trend lines give you the rhythm of the market. They also help identify when momentum shifts. If that trend line breaks with strong volume, the market structure may be changing. Finally, let's identify the fair value gaps, or FVGs. After a short consolidation near the top, price forms a strong bearish impulse leg. Notice how one large red candle drives straight down, leaving a clear gap between the previous candle's low and the next candle's high. This gap, highlighted and labeled fair value gap, shows an inefficiency in price delivery. Sellers overwhelmed buyers so quickly that the market skipped over prices, where buy and sell orders would normally have exchanged evenly. The upper boundary of the gap marks where the prior candle's low ended. The lower boundary marks where the following candle's high begins. The space in between is the bearish fair value gap, a zone of imbalance. When price later retraces upward into this gap, it reacts sharply. Sellers step back in at that inefficient zone, restoring balance before price continues to drop. Institutional traders view this as rebalancing liquidity. The market fills unfinished business within the gap, then resumes in the direction of the dominant move. So here's how you bring it all together. Use ATR to size your stop and target according to volatility. Use the median of price to determine whether the market is trading at a premium or discount. Use trend lines to define structure and bias. Use fair value gaps to find precise entry or re-entry zones. Together, these create a powerful framework. You're not just reacting to price, you're reading its rhythm, balance, and efficiency. When you can combine volatility, equilibrium, structure, and efficiency, you start to trade with precision. These tools give you context, confirmation, and control, the 3 pillars of professional trading. Use them together. Simplify your charts. And remember, precision beats prediction every single time. This is Breach and Clear Trading. Stay disciplined, stay sharp, and I'll see you in the next mission.